Well, thank you for signing in. We are sorry we have a delay a little bit. There are people that have signed in from Canarias, La Coruña, Argentina, Peru. Hello, and welcome to this series of webinars at University of Navarra, Graduate Campus in Madrid. These webinars, named Stop and Think Now, are a series of 5 live sections. It's a pleasure to be here this afternoon. And what we're really trying to do with these webinars is to reach out to our students, alumni and families, and to do what we can to help people, companies, to get through these difficult times. Today we start the webinars with a great speaker, Mr. Vítor Constâncio. He's professor at the Master of Banking and Financial Regulation at the University of Navarra. He's former governor of the Bank of Portugal, and he's former vice president of the European Central Bank. Just let me introduce you Professor López Espinosa, who is going to introduce and keep the conversation with Mr. Constâncio. So Professor López Espinosa is the director of the Master in Banking and Financial Regulation. He's professor of Accounting and Finance at the University of Navarra, a member of the Academic Committee of Center for International Finance.
I think we are on the...
I would like to give 2 announcements. Viewers are encouraged to send their questions and comments during the first 30 minutes of the conversation so that Mr. Constâncio will have time to answer the questions. And the other thing we would like to announce you is that the upcoming session will be on Tuesday, March 31st, with the title, How to Keep the Team's Energy in a Situation of Social Isolation. Thank you very much for signing in. If you are in Europe, good afternoon. If you are in United States, I have seen people that have signed in from California. Good morning. And if you are in Shanghai, good evening. Well, Professor López Espinosa, it's your turn. Thank you very much.
Hi.
Hi, it's Vítor.
Okay, thank you very much, Fernanda. I'm going to introduce Mr. Vítor Constâncio to the audience. Vítor Constâncio has been is a very important person in Europe, in the European Union. He was Secretary of State in Portugal. He was also Minister of Finance in Portugal. He was Governor of Bank of Portugal. He was academic also. He studied a degree in economics in Universidade Técnica de Lisboa. Also, he made a postgraduate in the University of Bristol. And then he's very famous because he was one of the saviors of the euro. Jointly with Mario Draghi, he was vice president of the European Central Bank at the most horrible time before coronavirus crisis in Europe during the European debt crisis. And they created the tools in order to mitigate the effects of the crisis. And one of this conference is going to be about, nowadays we're talking a lot about the coronavirus crisis. And how about he's talking about the policy measures taken to mitigate the economic effects of coronavirus crisis. Thank you very much, Mr. Constâncio, for attending the conference.
Well, good afternoon, everyone. And I'm going then to give an introduction to about the assessment of what type of economic policy measures should be taken to face the virus crisis. Trying to make it simple, although I would like to touch in a brief and as simple as possible way. We all know that we are facing an unprecedented situation because the health crisis has forced quarantines of lockdowns that froze the economy. It is as if the economy is hibernating, most of it. And as a result, of course, economic production is decreasing very significantly. The latest short-term indicators for Europe and for the US, but taking for Europe, the so-called Production Managers Index, and the effects of the virus crisis was not even totally felt. So there are many forecasts around about what is going to happen, but taking as an indication what is now already in for March, there are predictions that say that for the US, Q2 could show a decline of 50% in economic activity, with unemployment going up to 30%. And we had today precisely the numbers for the workers asking for unemployment subsidy in the US, which the previous reading was 282,000, and today it was 3.3 million workers asking for unemployment subsidy, which is an indication of what is going on in the US. Unemployment is not growing the same way in Europe, because there have been already some programs to try to support unemployment. No one knows what will happen going forward, say in the third quarter or the fourth quarter. This may perhaps improve a lot at the end of the second quarter during the summer. But in any case, the third quarter will be still weak in any case, because the economy will not revive immediately in a significant way. It will take some time. So we can count also on a weak third quarter. And if the fourth quarter is, say, normal, then we may have in 2020 a drop in GDP of 15 to 20%, which puts this crisis at this stage well above the recession of 2008 and 9. In principle, it will be more short-lived than that crisis in 2008, but it will be very steep and very significant. And this, of course, will have and is having already effects on the financial side of our economies. This crisis was not born like the other one from the financial sector, and the financial sector initially was, say, better prepared this time, but is already now being damaged by what is happening to the economy. I'm not referring even to the stock market. I'm referring to the increasing risks that we have in the corporate debt market. Firms, non-financial firms, are highly leveraged everywhere, more so in the US than in Europe. But in any case, we already see downgrades of ratings of firms. Say the auto producer Ford was just yesterday dropped its rating to junk status, and this is going to happen to more firms. So credit events may happen, and that will increase the risks for the balance sheet of financial institutions, including banks. So there is also a concern now growing with the financial side of the crisis. And of course, what is going to happen also depends on the type of policies that the governments will adopt to deal with the health crisis. But of course, I think there is no real trade-off, as some governments are portraying, between taking care of the people or taking care of the economy. We must take care of the people for all sorts of reasons, but even including in economic terms, thinking about the future, of course. So I think that in the end, the US, where these trends to now try to stop the lockdowns and social distancing early on, in the end will not happen, because the risks for deaths will increase enormously. So this is the prospect in terms of economic activity and the early forecasts that we see around. What is then in such a situation the priority of economic policy? Well, in general terms, it's, in my view, easy to define. If the economy is freezing, is hibernating, what we have to take care is to ensure that people, that they are then ready after the health situation changes to really restart economic activity. And that entails taking care of sustaining the income of people, in particular those that lose work during this period and are more vulnerable. Also trying to mitigate the increase in unemployment and layoffs, and sustain the firms to survive this period where many have no demand at all, because there is no demand for, say, hairdressers or airlines and many other sectors of services in our countries, and they have to survive. So this is a clear priority. And the programs have been coming, approved and announced by many governments, and they focus on the following type of measures. Well, in the first place, we see a few cases of direct transfers, direct payments to the citizens of the country. The more recent example of these few countries that have had this approach was the US, that just approved a total package of 2 trillion, which is more or less 10% of the GDP of the US, and several hundred billion of those 2 trillion will be dedicated to pay $1,200 to each adult, which means that also giving these $1,200 to people that have higher incomes or are upward middle class and don't need those 1,200, and it's going to be difficult to reach the real poor, because they are not in the fiscal administration database that will be used to send those checks around. So it seems a policy like a sort of temporary universal basic income, but it contains a certain amount of waste and some difficulties in reaching the more vulnerable ones. So this would be one type of policy. The other one, which is being adopted by several countries, is more effective. It's a guarantee of wages. So the state will pay sometimes significant percentages of wages of workers that otherwise would be dismissed or laid off. And so the state will pay with the condition that the firms don't dismiss or lay off those workers. And so, for instance, France is going to pay 85% of the salary of those workers, Denmark 75%, the UK 80%, and including in these beneficiaries of this measure also the self-employed, not just workers. And as you see, these and of course Germany has its program of Kurzarbeit, which is short-time work, that the state then covers the wages of the number of hours, half a day, that the workers will not work. So this guarantee of wages is indeed a good way of supporting incomes and at the same time mitigating unemployment, and that's a direct support to people. Then there is increase in unemployment subsidies, temporary, and extending the duration of unemployment subsidy, and many countries are doing that. Then there is the extension of paid sick leave. Oddly enough, the United States was the only country of the advanced economies that didn't have at all paid sick leave. So when people got sick and stay at home, they don't earn salary. They have now introduced paid sick leave, but they have exempted firms with more than 500 workers, and they have also exempted from the paid sick leave hospitals, clinics, and the health sector. Strangely enough. Then there are other measures like forbidding foreclosures of houses, and even some countries have also introduced a moratorium to mortgages payments to during this period support people not losing their house, which nevertheless creates the problem of how the banks will be compensated for that loss of their own revenue. Then there are measures to support the firms themselves. And here the public sector, the governments have created vast programs of loan guarantees. And also in some cases when they have the structure to do that, also to do loans directly to the firms. In the US, there is a small business administration that they can use for that. In Germany, they have the KFB and other institutions also to do that, and they are doing it, and also guarantees in many other countries. And discussions with the banks about these guarantees are ongoing in many cases, because of course, one thing is for the banks to know that there is a guarantee, but they need to know how much is that guarantee. And it would be then a cause of concern if the banks would not grant the necessary loans for firms to keep alive during this period, if they feel that the guarantee is not sufficient. But this is one of the bases of the support to firms in many countries. In some cases, governments are also injecting capital in firms. For instance, in the case of Germany, they have approved a program of 500 billion euros to provide guarantees, to provide loans, and to provide capital participations in firms. Not just straight subsidies and conditional, but participations in the capital of firms as a way of putting money, injecting money in those firms. In the US, they are also dedicating a big chunk of the 2 trillion, the 500 billion, to support firms through grants, subsidies, loans, guarantees, and so on. So this is an important element in the policies that have that are being deployed to help firms. This contains then also in many cases elements of subsidies and grants to sectors of the economy. The concern now is that some of these programs are difficult to organize logistically, and they will take time, and are taking already time, to reach the poor, the more vulnerable, the small enterprises. In some cases, there is nothing foreseen for the self-employed, for precarious workers in the gig economy, and so on. So the efficiency to reach those more vulnerable cases is a question right now, and it's a cause of concern that this perhaps will not be implemented in an efficient way. So all this, of course, means that the state unavoidably has assumed the role of the risk manager of last resort in any organized country. and that the state has to assume in their own balance sheet, in its own budget, many of the losses that are emerging as a result of this crisis. And this means increasing in public deficits and public debt. We don't know exactly the size of what this may turn out to be. The president of the Eurogroup, after an unsuccessful meeting of the Eurogroup that could not conclude any decisions, wrote a letter to the president of the EU, nevertheless revealing in that letter that the total increase in expenditures that is being planned by the member states of the euro area, in this case, amounts to 2% of GDP. That's a small number. For instance, the 2 trillion of the US, almost 1 trillion is for subsidies, loans, guarantees, so it doesn't go immediately to the deficit of the budget, but the part that goes represents 6% of GDP. In the case of Germany, Germany has expenditures of 150 billion, plus the 500 billion for loans, guarantees, and so on. 150 billion is 4% of the GDP of Germany. But to this 2% or 4% or 6%, one has to add for the deficit what countries will lose in revenues because of the recession in the economy. So there will be a drop in the proceeds of taxes and so on. In the case of Germany, they have estimated that another 3% will result from this drop in revenues because of the crisis. So the overall deficit will be 4 plus 3, 7%. If we add also 3% to the 2% that the president of Eurogroup mentioned, we have then an average of 5% deficits, but it will not stop there. Because in the first place, part of the loans and guarantees that are now given and are not immediately going to the deficit, they will not all of them be repaid. Guarantees will be activated, and when they will then transform themselves into actual expenditures and go to the deficit, and deficit will increase then. And that's unavoidable. Also, all these measures, and also the monetary policy measures about which I'm going to talk in a minute, just keep the economy going afloat during this period. When the health crisis ends, then there is also a problem of real additional economic stimulus to increase growth in our economies, which will mean then more fiscal deficits and debt. So one could ask, and certainly everyone asks, what is then going to happen, because there are already high levels of indebtedness of governments everywhere, some more than others, but this is already a situation of that sort. How is this going then to be addressed going forward? What are the problems that this will create? Well, one could compare, because in a way we are at war with the virus, that during the World War II, the major countries involved in the war had deficits every year of around 20% of GDP. So higher than what we are perhaps considering as possible, and this will be shorter than, say, the years that the war lasted. And after the war, then how was this huge debt that was accumulated absorbed? And when I say absorbed, is in terms of the evolution of public debt over the GDP, that ratio, which is of course important. And there are 4 ways for that ratio to be reduced. One way is if there will be more inflation. And there was a little bit more inflation after the war, after the Second World War. But right now, we don't see inflation coming in a significant way. We may have, even during the more short time, a reduction in prices because of what has happened to oil price. That will have a huge impact on inflation in general, as it has had all the time. And so we may have even nominal deflation for a period of time as a result of that, and inflation is not coming. The second way is to have more growth of the economy. And that happened also after the Second World War. With the recovery, there was higher growth. Well, we cannot expect that also this time very much, because we were already in advanced economies, at least in what has been called secular stagnation, as a result of demographic factors, of technological factors, and growth rates were already on the low side. And after these crises, there will linger a period of risk aversion of economic agents that also will not lead to very buoyant growth. And there will be also a decline of globalization, arming world trade. And that also will weigh down on growth possibilities going forward. The third method is financial repression, is for central banks to keep interest rates very low. And that was also used in many countries after the Second World War, particularly in the US. The Fed maintained low levels of interest rates to help the burden of the public debt. And this is happening now with the huge programs that the central banks have already embarked on, and will continue to be the case. So we can expect a period of low inflation going on, and a longer period of low interest rates than we could think before this crisis. Well, the fourth method, of course, is to have defaults, restructuring of debt. This is not, of course, a solution or being contemplated this time. So this on the result of the fiscal deficits and fiscal and debt. It's also good to remind everyone that in what regards the public debt and the ratio between the debt and the GDP, the dynamics of this ratio over time is such that when the interest rate is lower than the growth rate of the economy, the ratio of the debt to GDP goes down. And that's a way of absorbing the excess indebtedness in relation to the GDP of the economy. So that's what central banks are doing and will have to continue to do. Turning then precisely to central banks and monetary policy. So central banks have, besides the objectives of controlling inflation, which has not been so difficult because inflation has been on the low side, not on the high side. Besides that, they have also, of course, responsibilities and concerns with the financial stability. So in the stressful situation, like in 2008 and now, central banks have to ensure liquidity of the banks to start with, but also of markets, of market liquidities. In a way, central banks turn a sort of market makers of last resort. And that's what we are seeing again. The major central banks, the Fed, the ECB, have started to purchase securities to normalize and put a backstop under those markets. And the central banks are buying lots of things. They are buying sovereign bonds, the public debt. They are buying corporate bonds. They are buying asset-backed securities backed by mortgages. They are buying also bank covered bonds, that the bonds that the banks issue covered by their portfolio of mortgages again. And this time the ECB, that's a new thing, is also buying, besides corporate bonds, is also buying corporate commercial paper, short-term paper issued by non-financial firms. The Fed is even buying more things. The Fed, besides all these points, is also buying municipal bonds, is also helping directly money market funds. So it's as a broader range, because those other elements are more important in the financial system of the US than in Europe. So that is very important to normalize those markets of our financial system. The ECB has then announced a program of 870 billion, because the 750 add to the 120 that had already been announced to buy these things until the end of the year, and has clarified that it will it can do more than this. These 870 billion is around 6% of the GDP of the euro area, and implies a lot of financial power going into the markets. And the ECB has also decided something that many were not expecting, that the limits of the purchases, which before were defined in a way that the ECB could not buy more than 33% of the debt of each country, of each issuer, that limit is not applicable to the new program of purchases of sovereign bonds and all the other types of securities that the ECB will be buying under this emergency program of 870 billion until the end of the year. And the ECB has also said that it will be willing, of course, to use the program of OMT if it will be necessary. You may recall, some will not know about it, but in 2012, when we had a big phase of attack on sovereign bonds on several European countries, members of the euro area, the ECB announced a program of going into purchases, unlimited purchases of bonds of a particular country that was under stress, with yields in the market that would be above what would be the fair value of its bonds, would be willing to do that, provided that the country would have at least a precautionary program with the European Stability Mechanism, the ESM. And that program was never used after the fact, but as we know, ended the sovereign debt crisis because then yields and spreads collapsed after the announcement of that OMT. So the OMT is there. It was considered legal by the European Court of Justice, so it's there. It depends on the countries. If they need, some countries don't want to ask any program with the ESM, but as I said, a simple precautionary line, not a full-fledged adjustment program, a simple precautionary line with the ESM will be enough for the OMT to be used. So these are then extraordinary measures, because the financial stability concerns, and the banks in particular, were also addressed by the measures announced by the ECB. The ECB announced a new program of long-term refinancing operations for the banks at very cheap interest rates, with maturity for 3 years if the banks draw and use those lines. And if the banks will be able to ensure that the credit they provide will increase by at least 2.5% until March of next year, if they can assure that, then the interest rate that will be applied to this liquidity facility will be minus 0.75 percentage points, which is below the deposit facility rate of the ECB, and it's quite low. And so the banks, if indeed they will increase somewhat their credit by that amount, will receive here a good incentive to try to keep and increase somewhat their credit portfolio, because they will earn this difference of borrowing from the ECB at very, very negative interest rates. Besides that, the supervision part of the ECB has decided to give some capital relief to the banks, meaning that to the total amount for the European banks of the euro area of 120 billion euros, the capital can be reduced by absorbing losses, and the supervisor will not ask immediately for the banks to replenish that reduction in capital by 120 billion. Also, the application of the new rule about provisions that oblige the banks to create provisions with costs, looking to the future risk of their loans, will be applied in the minimum way according to the rules for the transition period that was in place. And also the loans that the banks will give and will be guaranteed by the public that are emerging, those loans, even if they start to not perform, will not be classified as non-performing loans because they have the state guarantee. More for the banks very likely will be necessary down the line, because as I mentioned, the financial side of the crisis is now evolving. And if there are credit events, meaning corporate bonds that don't pay, that have default, or structural leverage loans and other types of credit where the banks are involved, that may start to increase the losses of the banks. There are also concerns with the banking system of some countries more vulnerable with weaker situations, and that may require down the road a support, again, like in 2008 and 2009, by public capital to inject capital into the banks. And if that comes, perhaps not, because the situation of the banks is better now, but if we get to such a situation, then the part of the legislation that imposes that public support cannot be given to banks before there is a bail-in of shareholders, of bondholders of the banks, that legislation will have to be suspended during a period of time. Because turning to the policies at the European level, precisely what Europe has done is to suspend several of the rules that were, of course, for normal times. The Stability Pact, the rules about fiscal deficits and fiscal behavior have been suspended, all of them. They don't apply now for this period. Also, the rules about state aid that is forbidden in many cases for to protect competition in Europe, those state aid rules have been very much now turned flexible in order to allow the guarantees of the state to loans to firms, subsidies or grants to the firms. All that would be under the scrutiny, and many cases would be forbidden by the competition rules. But again, flexibility has been introduced. So this is also in a way suspended during this time. Now, what is missing at the European level? Well, at European level in terms of fiscal policy or policy to help the member states with loans, what is missing is more initiatives of common in-depthness to help the countries. So the question of the famous Eurobond has come up. Nine governments have written to the president of the European Union to proposing the issuance of Eurobonds to help in common cover part of the needs that the states have. This would of course mean that the costs of those Eurobonds would be much cheaper, which would help the member states. The alternative is for member states to use the ESM lines with precautionary programs that can and should, if that is the case, should be changed into much lighter conditions, even for the precautionary credit lines. At this juncture, the imbalances in the countries has not resulted from misbehavior of the countries, but from this exogenous shock, which is common to all states. So that needs to be changed. And to end this introduction, I will mention some ideas about the longer term, what will happen down the road. I already addressed some of them. The first one has to do indeed with the question, are we going to have more inflation after all these increases in money, in the monetary base, by all these issuance of central bank liquidity, by the central banks, by the bigger deficits and bigger debt? Are we going to have more inflation? Well, no, we are not. Even we may have a period of even deflation, because the oil price, which was in the past 2 years, say, more or less at levels of $80 per barrel, it's now a little above $20 per barrel. And there are voices and analysts that say that is going to be even lower, because there is now a shortage of space to keep oil, because the Arab countries have increased production a lot, and that the price of oil is going to go even below $20 per barrel. That will impact inflation in a big way during a period of time. And so inflation and concerns with the excess debt will be dealt, as I mentioned already, by monetary policy that now conditioned to keep interest rates low for longer. Second question, what about economic growth? Well, economic growth also will suffer even after this is over, because there will be a legacy of risk aversion after such a big shock and its effects. People will be more prudent in many ways, and so that will impact growth. And also globalization, supply chains will be shortened this time. It became evident, for instance, that in what regards pharmaceutical and medical supplies, the world was too dependent on China. And that delayed and is delaying the increase of many elements of medical supplies that are necessary and are missing, from masks to many other things. So supply chains are going to change, and meaning that the world trade is going to suffer, and that is not good for economic growth looking forward.
So I'm going to try to, there are people, the audience, I selected some questions from the audience. What is your opinion about to issue Corona bonds conditional on the implementation on responsible fiscal reforms?
Okay. Yeah, I am totally in favor, of course, because it would be help for the countries. It can help to prevent down the road pressures on the debt of some more vulnerable countries. Common issuance of Eurobonds means that this facilitates the access to financing by all states, and some states down the road, if this continues for more time, and we don't know, and debt increases, may face problems of market pressure to access financing, and Eurobonds would, of course, avoid that, and also would provide cheaper financing to the states. So there is a justification for that. The result of arbitrary expenditures or tax cuts done by the member states. It was the result of these crises, and we are in it together. And it's a common shock. It's a shock for all countries. So if ever there was a situation where Eurobonds would be justified, is now. It doesn't mean that the Eurobond program would continue in place forever, but it would be for this phase where we are to have an European response to the crisis that we face. Final point. The ESM, the European Stability Mechanism that provides loans to countries, issues Eurobonds, because when the ESM lends, it has to get the money from the market by issuing bonds that are indeed guaranteed by all states, by all member states. So they are Eurobonds, what they issue to the market. The difference is that the loans that then the ESM gives to the countries are not unconditional, are conditional on measures, because the ESM was created when there was a sovereign debt crisis and the need for adjustment, some degree of adjustment in the economies more in depth. We can discuss, and it was much discussed with reason, the degree of that adjustment, but some adjustment was necessary. So the ESM was created in this context. Now it's different, and nothing prevents that the member states that are members of the ESM, the Euro area countries, of deciding a new credit line practically without conditionality, except transparency, information, conditions for the future, not immediate, so that would not be a burden immediately on the countries that would have access to those loans. And those loans also would be financed by Eurobonds when the ESM issues its own bonds to take the money from the market. This would be a possible alternative to straight Eurobonds. But we need something, in my view, of this sort that involves common responsibility of all member countries to help each other in such a situation. Because this crisis was not started in the financial sector, there has been much less talk about the financial crisis that has started as a result of this. But it's there. It's already evolving. And financial stability concerns should be more prominent in our thinking. For instance, as I said, I think that if losses in the corporate credit market will emerge, downgrades, partial defaults, and losses for the institutions, beginning with the banks, then if that really goes in a significant way, it may be the case that banks will need capital support down the road. And one way to provide this support would be to change the rules about the direct recapitalization from the ESM of European banks, meaning that it is in the rules of the ESM that there could be direct recapitalization of banks by Europe directly, or loans for the states then to inject capital in their banks. All these programs, nevertheless, are now conditional on the previous application of the Directive of Bank Recovery and Restructuring, the BRRD. And that directive imposes that before any public money is used to help banks, then before that, the shareholders, the main bondholders, will have to be wiped out. Their stakes would disappear to then help the bank before any public money could be used. Well, that would aggravate, of course, the crisis enormously. So for these programs to help the banks to be effective and really acceptable, these BRRD would have to be suspended also temporarily, as the Stability Pact has been suspended, as state aid rules have been suspended, and so on. But that's down the road. It's not immediate. Regarding shadow banking, I would say the concern, of course, is with also insurers and pension funds, because if there will be defaults of corporate bonds and other type of securities, they will suffer. But also there is the question of the investment funds, which is a different question. It's not a capital question, it's a question of liquidity. We have seen already last year in Europe, in that case in Switzerland and the UK, not a Euro area country, but there were cases of broken investment funds because there was a run on them, meaning asking for redemptions, and then they had not the liquidity for that. And there is a liquidity risk in investment funds if there would be a run on redemptions.
We appreciate a lot. This week was hard for you because you taught 2 sessions on Mastering Banking and Financial Regulation. We appreciate a lot your conference here. Thank you very much to all of you to attend this conference, this webinar. We are so sorry for the technical problems that we experienced in this. We tested twice the platform, but it seems that something went wrong. So thank you very much to all of you. Thank you very much, Professor Constâncio. We appreciate a lot. And we will have next webinars next week.
Bye. Bye, everyone.